Hello, and welcome back to Financial Education. My name is always Zach Collins, and today I want to go through a few basics and common misunderstandings around HECS. If you don't know what HECS is, it stands for Higher Education Concession Scheme. People also use the term HELP, which is Higher Education Loan Payment. Essentially, what we're talking about is student loans for university. Before we get into that, for those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I'd love to get that license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and his firm was very heavy sales. I have no interest in sales. Being a financial advisor is not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. We're very lucky here, in Australia that HECS is a government loan. Other places in the world you have to get a loan from a private company and you pay exorbitant interest rates, while ours are fairly low. I'll get into that a little bit later on. We're also lucky that we get a subsidized position at a university. International students have to pay the full fee. We only have to pay a subsidized rate. That is called CSP, or Commonwealth Subsidized Placement. The subsidy changes based on what courses you choose and whether the government wants to increase or decrease the number of students during those specific degrees. The amount of fee that you had to pay was changed a few years ago, back in the Morrison government era. And what he did was he made it cheaper to do courses like STEM. This stands for science, technology, engineering, and maths. And then he made it more expensive for specific courses like arts or accounting. His aim with this was basically to affect the supply and the demand curve. To increase demand, they lowered the prices of the degrees they thought they wanted people to pursue to increase the demand. They then increased the prices of those who thought, we got too many graduates in. Now, this only works in the free market. I'm not going to go into my personal opinion, but with HECS and other government debts, demand generally doesn't change a lot. The demand curve is fairly flat, meaning it doesn't really matter what the price is. Demand doesn't change. If you want to do a Bachelor of Arts, you will. You're not going to suddenly get good at math or science and want to pursue a career in STEM just because it's now a $5,000 difference in price. The end result is that people will generally just end up with more student debt when they finish their uni studies. Anyway, so what is that debt? That's the HECS. HECS is a fairly unique form of debt, as it's a debt with the government. They can and have made a few unusual rules around it. There is a lower threshold at which you need to start paying that back. It means that if you do not earn enough income, you don't have to pay anything back. Then the loan just keeps accumulating in the background. The lower threshold last year was around $54,000. However, starting the 2026 income year, that's 1 July 25, the Labor government recently lifted that to $67,000. I've included in the description below a link to all the thresholds and the repayment rates. This is a massive jump in the lower threshold. This means even more people won't have to make any repayments. It also means that given the median wage is somewhere in the $85,000 to $90,000 level, there's a lot of people that will potentially never earn enough money to pay back the student debt. If you have exceeded the threshold, then you have to pay a fixed percentage, kind of like an actual little tax. It's not really a tax, but you can think of it like one. You're making extra payments to the tax man, but you can call it whatever the hell you want. The percentage you have to pay each year is based on your income, not on the balance. So if you have a $60,000 HECS balance or a $10,000 HECS balance, your repayment amount is the same. You can't actually reduce your payment liability through deductions or salary sacrifice. This will reduce your taxable income and the amount of tax that overall you have to pay. Now, your taxable income, if you don't know, just to keep it simple, so it's your gross income less any allowable deductible expenses. Your HECS threshold is based on something called your gross or adjusted taxable income. This means if you do have a salary sacrifice in place, it might be best to ask your employer to withhold additional tax to cover that HECS shortfall so that you don't end up with a tax debt at the end of the financial year. To be clear, getting a tax debt is not necessarily a bad thing. You're still paying less tax overall using a salary sacrifice. You just need to make sure you keep a little bit of extra cash on the side to pay that additional HECS liability because the employer isn't withholding enough. The actual amount you pay in repayments doesn't change. HECS is also unique in that it doesn't accrue interest, technically. It's indexed to both inflation and wages. I personally consider indexation and interest to be essentially the same thing, or at least similar enough. While technically they're not, interest is not set on the macro environment. It's based on how much the corporations want to make. They can charge you whatever they want. It can be super low. In the COVID year, we saw 2%, or it could be over 20%, like we see a lot of credit card interest being. Indexation, however, is generally linked to something fundamental in the economy. This is both good and bad. The last few years' inflation has been really high. This means that indexation has also been really high. Historically, it has been in the 2% range. However, in the last 3 years, inflation and indexation, therefore, have been around 5% and above, which means that a lot of people aren't actually making any headway in paying down their HECS debt. While it may be getting eroded over time by inflation, it is very disheartening seeing the amount you owe never change. Sometimes it even continues to go up. To fix this, the government adjusted how HECS indexation was calculated. Previously, it was just based on CPI, and that is why indexation was so high the last few years, purely due to the high inflation. The Labour government changed it so that it was the lower of either wages index or the CPI, because wages over that same period grew slower than the price of goods. This means that the indexation amount for the 23 and 24 income years is being cut, and going forwards, your wages should always outpace or match the indexation of your HECS. You should never be going backwards anymore. The final important piece of information I want to mention is that HECS is not like normal debt. By that, I mean that you can't just wipe it by declaring bankruptcy. At the same point, however, if you were to pass away, the debt disappears with you. It's not something that's passed on to your estate to pay. This does mean you could be homeless and have tens or even hundreds of thousands of dollars in HECS debt, which will never be paid off. This is both good and bad, as it means your family never has to worry about your student loans. But it is also leading to scenarios where the older boomer generation, who have almost all retired by now, they're starting to go back to uni to pursue, say, a passion degree. And they're incurring debt that they will never earn income on and likely never have to pay. They were the lucky generation that didn't have to pay for their first degrees. And, if they don't get a job after they graduate with the next one, they won't have to pay for this one either. You have to consider the consequences that this will have on future generations. Hopefully, I'm able to give you a bit of a better understanding of how HECS works. If you guys have any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you so much for watching, and I'll see you guys in the next one.